Okay, guys, now we're talking options a little bit more today. There are going to be some more definitions towards the end of this video, but we wanted to take a look at a profit loss graph for both sides of a trade. So we're going to take a look once at the call option and then once at a put option. Now, when I drew up these examples, this was done back in December. Twitter was trading at $30.20. So even though the call option premiums may not have been this price. I'm just picking a price for this current example. Okay. So what we're saying is we're long or we bought a call option or we bought the right to buy. Okay. A June 30 Twitter call. Okay. At a cost of $2.85. So $2.85 is what's referred to as the options premium or the price of the premium for the contract. Now, one contract is the right to buy 100 shares. So we multiply the premium times the number of shares, and this is going to be our cost. Okay, so it's going to cost us $285 for the right to buy Twitter at $30 per share between now and June. Okay, now what we've modeled here is what we've paid is really what we can lose. But the way options are done is I can't lose anything more than what I paid. Or at least in this side of the trade. Now, since I'd be buying at $30 a share, okay, and it costs me $2.85 to get that right, our break-even cost is going to be $32.85. Because when you take a look at this, 30 times 100 would be $3,000 plus $285. So that's $3,285 is the total cost. And divided by 100 shares, so the cost per share or your break-even point is $32.85. Anything above that price, and we actually start to make money. Okay. If we go below 30, like 25 or anything like that, there is no reason why you would want to pay $30 per share when you could buy it in the open market for 25. So the call option will become worthless if it's below 30 by June. It's usually the third week in June, third Friday in June, excuse me. Now, that being said, you do lose some money, but not 100% of your premium if the price goes between 30 and 32.85. So let's say hypothetically, the stock goes out in June at 32. Okay. Well, there'd still be some value in this. I could buy it at 30 and quickly sell it at 32 and make $100 per share. Okay, but I'm going to make a profit of $200. It costs me $285 to do that, so I would have a loss of $85. Okay, but once we get above the break-even price, we're going to start to make money on this deal. Now, anything below the strike price or the break-even price is anything below the break-even price is a loss. Anything below 30 is a complete loss. Okay, the maximum the buyer could gain though is theoretically unlimited. Okay, Twitter could go to 1 billion. The probability of that happening is low, but it is theoretically unlimited. Now let's take a look at the other side of this transaction. We had to buy the call from somebody, so they had to sell it to us. So they're the writer of the option, or they're selling it to us. They're shorting it. So same strike price, 30. It's expiring in June. Okay, and they took in $285 in income. They have the same break-even price for as we do. They will make money as long as it's below that price, and they start to lose money if Twitter goes above 32.85. Okay, so if Twitter stays below 30, they keep 100% of the premium. So this is a nice little bit of income for them. Now, theoretically, though, the loss is unlimited. This is the exact mirror image of the long side that we just took a look at. So break even price is 32.85. Anything below this price is a gain, as the option will expire worthless. While anything above this price is a loss. The maximum gain they can get is 285, and the maximum loss for the seller is theoretically unlimited. Now, most people don't sell options what they refer to as naked. They don't have any other position. But what some strategies or some people do is, if they own Twitter and they don't feel it's moving anywhere anytime soon, to generate some income, they can sell a call option against them. So if the call buyer wants to exercise their option and we're obligated to deliver those shares, well, we already own them. We don't have to go out into the market and buy them. So that's selling a covered call. That's a strategy that we can talk about in later videos. Okay. Now, this is a chart pre-market of put options. Okay. And we'll take a look at this a little bit later. But let's take a look at the profit and loss of people that are buying and selling puts. So this is a little bit tough to wrap your head around, but I am long a put option. I am buying the right to sell Twitter at $30 per share from now till June. Okay. And I'm really, what this is I'm buying downside protection. Okay. So I think this might go down, and I want to make sure that I lock in my profits. Okay, so it's costing me one option is trading at a value of $2.47. So since each option represents 100 shares, each options contract represents 100 shares. It's 247 times 100. So it's going to cost me $247 to protect this position. Okay. So if if Twitter stays above 30, so then my position is fine. The Twitter stock's not going down. Then I basically just lose my total cost. So I'm going to have a loss of $247. But as the price goes down below 30, the value of the right to sell at 30 goes up. But what we're going to say here is 30 minus $2.47 takes me to a break-even point of $27.53. At that exact point, we would be break-even. We'd have no profit and no loss. The second we go below $27.53, we actually start to make money on the options contract, and there's a slope of -1 on that. So for each dollar that Twitter goes down below this price, we're going to make $100. All right. So now $27.53 is the break-even price. Anything below this price is going to be a gain. Okay. Because it's going to have the right to sell at 30 is going to have a lot of value when the price is at 25 or 20 or even lower. Okay. The maximum loss that the buyer of the put can get is $247. Okay, so whatever we paid for the premium, whatever we paid to help us sleep at night because we thought Twitter might go to zero, that's all we can lose here. But if Twitter does go to zero, okay, then we could have a maximum theoretical gain of $2,753. Okay, because I could buy it for zero, buy the stock for zero, and sell it for $30 a share. Okay. Now, we'll scroll down here and we're going to take a look at the mirror image again. Now, short writer, so basically they're selling the put. Okay. Now, if you're selling the right to sell, it means you're looking to buy this. And this is one way, an option strategy where you can get income and buy at a lower price. So if Twitter is trading above $30 per share, it's the right to buy or excuse me, someone is not going to sell at 30 if the price is above 30. Okay. But if you sold them the right to sell, that means you would be the one buying and delivering it to them later. Okay. So on this side of things is we're going to take in the income, $247. Now I'm going to hold on to that income. And if Twitter stays above 30, we just get to keep it. But if Twitter dips below it, we're going to have to buy those shares, and we're going to use some of that option premium, the 247, to acquire the 100 shares at $30. So this lowers our buying cost structure, and it really makes us willing to buy Twitter at 27.53. Okay. So this is still the break even for the call buyer. It's the break even for the call seller. But since I'm selling, the most I can make is the income or the premium that was collected. Okay. So the maximum gain is the premium that could be collected. Once again, 27.53 is the break even price. Anything below this price is a loss. Anything above it is going to be a gain. And the maximum theoretical loss to the seller is going to be $2,750 if Twitter goes to zero. Okay, now intrinsic value. Basically, what we're doing is we're taking a look at an option premium and deciding how much of it is intrinsic or in the money, and how much is extrinsic. And we'll do a little bit of the definitions in a minute. I'm gonna have to scroll back up to take a look at those option charts. But intrinsic value is the in the money portion of a call option or a put contract. Okay. And sometimes there's no part of the premium is in the money. Okay. But if the share price of Twitter was currently $35 per share, and a call option with a strike price of $30 would have an intrinsic value or in the money value of $5. Okay, I'm going to take a look at that same example again, but with extrinsic value. Now, extrinsic value is the portion of the options premium that exceeds its extrinsic value if it is in the money. Okay, if in the above scenario, the $30 Twitter call had a premium of $7 when the share price of Twitter was at 35, then the call option has $5 of intrinsic value and $2 of extrinsic value. So this $7 gets cut up into what was in the money, $5, and what is not in the money, $2. So the extrinsic value is what you're paying because the option the underlying security has volatility, and there's time to expiration. So there's a value that you're willing to pay for that. And that's what's called extrinsic value. Now, time decay. The way options are structured is whenever you buy it, as each day goes by, you get closer and closer to the expiration date. So as we get closer and closer to the expiration date, there's less of a probability of the stock making that move before the expiration day. So the value or extrinsic value of the option starts to erode over time. Okay. And it's referred to as options price decay. So time decay. The rate of this decay increases as expiration gets closer. Now, many of the option contracts that we'll be talking about are going to be American, and that means the option can be exercised anytime before the expiration date. But some option contracts, mostly commodity contracts, are structured as European, and that means they can only be exercised at the time of expiration. All right, now in the next video, we're going to take a look at some numerical examples. When we come back from break, we're going to try to hammer that concept of intrinsic and extrinsic value when doing option pricing. We are going to take a look, though, in the next video at what would be the difference between buying the stock outright and buying the right to buy. So we're only looking at a call option or owning the stock directly.